So why do we have accounts receivable? Why would anyone agree to sell a product and not get their money back 30 days, 60 days, sometimes even 90 days from today? Why do people do it? Why do business owners do it? Well, there's one simple reason. The reason you have accounts receivable because it helps you increases your sales. So in other words, if your accounts receivable is not increasing your sales, then you really need to rethink your strategy. So, accounts receivable has its downside. For instance, there's a chance that people are not going to pay you. So, you have the problem of bad debt. Then, what about the opportunity cost of cash? Your cash could be doing other stuff, increasing your growth, investing in marketing, buying new products so you can reinvest in your business. Not only that, you have to get additional staff to maintain your accounts. Then there's the interest cost if you have to take a loan to meet your working capital needs. Then there's the background checks and collection services you need to do. And then things like office supplies like paper and ink you use to send to customers who owe you. I mean, there is a cost to accounts receivable. So let's talk about credit cards and accounts receivable. When you offer your customers the choice to pay accounts receivable with credit cards, it's like your customers are double dipping. First of all, you've given them the salient account, and then they're paying with credit card. You're increasing your cost of credit because you got to remember one of the main functions of accepting credit cards is the ability to collect payments faster. So if you're not collecting payments faster, but yet you're incurring accounts receivable, then there's something seriously wrong there. And I think a lot of that comes from that's the way business has always been done. Accounts receivable with credit cards defeats the whole purpose of accepting credit card because if you're supposed to be collecting payments faster, then why do you have accounts receivable that's 30, 60, 90 days from today? There's something seriously wrong with that picture. So how do we get here? Most times we simply do things because it's just the way it's always been done. We don't really stop to think, okay, what is the best applicable solution to my business? We know we've seen that we worked for a business. We saw they collected an account. We saw they accepted credit cards. We've been to businesses that have done that. But when we start our business, we don't really think or become innovative in the way we collect payments. The way you run your business should be unique to your business, not because it's the way it's always been done. Just because everybody else collects credit cards and accounts receivable and gives accounts receivable does not mean that that's applicable to you. Now, there are some businesses that will work for it because the combination overall increases sales. But for the most part, there are a lot of businesses this does not work for, but they do it anyway, just because it's always been done that way. So how can we make a change? Well, if you accept credit cards for accounts receivable, think about adjusting your policy where customers pay before they get the final goods. In exchange for credit card fees, you reduce your chance of accumulating accounts receivable. You know, be innovative. You don't have to do things like everybody else. So what is the accounts receivable turnover ratio? The turnover ratio computes how many times the accounts receivable is turned to cash in a year. The higher the ratio, the shorter your collection period. Soon I will show you exactly what that means. To compute your accounts receivable turnover ratio, at least 2 years of financial statements are recommended. That's because we're going to look for the average accounts receivable. So first of all, you need your income statement where you get your revenue. So here we can see our revenue of $2,097,000. Then the next thing you need to go to is your balance sheet statement. In your balance sheet statement, you have the line called accounts receivable. So you want to take the average of 2 years. So in this case, we'll take 500 plus 450,000 divided by 2. The reason we do that is because we want to take into account variations that might take place in the year. So by averaging 2 years, it kind of smooths out our calculations. So let's take a look at here. Here we have accounts receivable turnover equals sales divided by average accounts receivable. We saw in the statements that revenue was $2,097,000. Account receivable current year was $500,000. Prior year was $450,000. So the AR turnover is the $2,097,000 divided by average of the 50,000, 500,000, and 450,000, which is equals 4 times. So that means we turn over our accounts receivable 4 times in a year. However, the number of days to collect, which is if you want that times in days, we divide by the number of days in a year, which is 365, and divided by the account receivable turnover ratio, which is computed here. So which would be 365 divided by 4, which is 82.7 days. So this means this business on average takes 82.7 days to collect its accounts receivable. To fully understand what accounts receivable turnover means, you have to put it in conjunction with other activity ratios, such as how fast you turn over your inventory and how fast you pay your vendors. So we're looking at this example here, and then we can see that the number of days it takes to turn over the inventory is 36 days. So on average, this vendor is replenishing his inventory on average every 36 days, while it's collecting from its customers every 83 days. On average, it's paying its vendor every 30 days. By the time payment is due, we have 118 days that has passed because we have to add the 36 plus 83, so that's 119 days has actually passed before we can collect on the accounts receivable. However, you have to pay your vendor in 30 days. So we have an 88-day financing gap, which is there's 88 days we're going to need cash. We don't have the cash because we have not collected it from the time we get the inventory to the time we have to pay our vendors. This could be very disastrous for a business because it creates a need for always having other cash. Obviously, that cash gap has to be filled by other methods of financing the business, either money from the owner from outside the business or from bank loans. So we've established the fact that this business is selling 2.3 times faster than it's collecting its accounts receivable. This is causing a financing gap of 88 days. So what happens if they just choose to work on their account receivable policy and reduce the amount of accounts receivable they actually have on their books? If they reduce it by 5%, we can see that the number of days they need to finance goes down to 84 days. However, if it goes down by 10%, they only have 80 days to finance. If it goes down by 20%, they only have a financing gap of 72. At 40%, it's 55. At 60%, it's 39. And at 80%, it's 22. Wow, a 400% change in the financing gap. That's amazing. So just doing business the way it's always been done and always robbing Peter to pay Paul is not a way to do business. If you're always cash strapped, you really need to sit down and think about your account receivable policy. So what do the results of the accounts receivable turnover mean? Well, to really understand accounts receivable turnover, you have to compare it with different things. And here we're going to look at the whole operating cycle, including how often you turn your inventory and how often you have to pay your vendors. So here we see that accounts receivable turnover in our example, we computed that to be 4 times per year, and number of days would be 83 days. Well, what does that mean? Let's put that in perspective of how often do I sell my inventory? My inventory turnover, I sell my inventory 10 times a year, and the number of days, which is 36 days, it takes me 36 days before I sell my inventory. I completely turn over my inventory. And so if it's taking me 36 days to turn over my inventory, it's taking me 83 days to collect from my customer. I have 36 plus 83 days. So I have 36 plus 83 days, 119 days that I am waiting before I see any kind of cash from the very first time I actually buy my inventory. Well, if my vendor term is every 30 days, I'm paying my vendor every 30 days, then there's a problem because if it's taking me 119 days to collect my cash from the first time I buy it and sell it, and my vendor wants the money in 30 days, I have a financing gap of 88 days. So we can see how having accounts receivable can actually be a problem. And then here What if, there's a what if scenario, what if you can decrease your accounts receivable by 5, 10, 20, 40, 60, 80%? We go down to 80%, we see our financing gap has gone all the way down to 22 days than 84 days. It will be so much easier to find a loan if we tell the banker we can turn over that money pretty quickly and pay them back quickly than if we know that we probably wouldn't get the money for 84 days, and that's how the gap we need to fill in that business. So the faster we can collect our cash, the less we'll need the bank to finance us. And if you can play with these ratios and see, okay, if I can turn over my inventory quicker, collect quicker, and then maybe pay my vendor later, that helps you out in that if your vendor can improve your terms, because then your financing gap is much narrower. Now let's take another example where we see a business owner having accounts receivable work in their favor. Inventory turnover, number of days. They turn over the inventory every 12 days. So they have inventory that sells like hotcakes. Very good. The products are moving. They have accounts receivable turnover 3 days. And basically, it's just the number of days it takes from the time probably someone swipes a credit card on their website or in their business till the bank actually deposits money in the account. So on average, nowadays it's less, but let's say it takes 3 days for them to get the money in their account. So they're really not keeping accounts receivable. Rather, they're using credit cards for the right purpose, which is to increase the speed at which they receive payments. The vendor term is 30 days. And then here we can see a financing gap of -15. This is awesome because this means your vendors are actually financing your business. You don't, all things being equal, let's say there's nothing else going on in the business, there's no expansion, there's no nothing. You don't even need external bank loans just to manage operations because your vendors are actually helping you finance your business. Let's take a look at other costs of having accounts receivable in your books. One, it's your opportunity cost, the interest cost, the savings interest rate you're missing, the interest on loan, if you have to take a working capital loan and use an accounts receivable as collateral. There are a lot of businesses that offer that these days. That's a cost. Office supplies for the letters you have to send out. Then the collection services, labor hours for collection services, the phone calls, the updating account, or even if you hire a third party. That's all cost to managing your accounts receivable. And every month, you have this accounts receivable on your books. You're incurring this cost. So this is a monthly cost. So to get your total cost still payment, you have to multiply by the number of months in which they have accounts receivable. In our previous example, it was 2.76 months. So 2.76 months per the monthly cost. This is how much every month. How much till payment it's costing them, based on their monthly cost just to collect. And that's just the monthly. Let's take a look at the one-time cost. There's also a one-time cost of incurring accounts receivable. For one, the bad debt estimate. Well, not everybody who owes you is going to pay. You have to estimate what that bad debt is. The credit card fees are attributed to accounts receivable. So here in another example we saw where the credit card company was actually taking over the load of having account receivable on your books by helping you speed up your payment. Well, if you're collecting credit cards and having accounts receivable, well, those fees are a cost for carrying that accounts receivable because you really don't have to have both. The cost of the background checks, if you really, when you're giving big credit, you want to really make sure that this person is actually going to pay back. That's a cost. It's a one-time cost. However, all of this cost is offset if you project that, well, if I don't collect credit cards, my sales are going to go down by 20% or 10%, whatever. So you make that estimation. And that estimation really offsets everything. So here in this place, without credit cards, this business owner estimates 20% of its clientele is going to go somewhere else. So by accepting credit cards, they increase their cost, their revenue. So that makes sense. So that's a positive offset. So at the end, you want to total your total cost. So here, the total one-time cost is a positive 188,730. So the gain from revenue is really way more than they're paying out. And then we have to subtract our one-time monthly cost too. So the net gain In this case, for accepting account receivable is 188,289. So in this case, overall, it actually end up working for the business, but it's not always the case. You actually want to sit down and see if that actually works out for you. Because if your sales are not increasing if you still have the same client base, whether or not you accept accounts receivable or not, then you really need to sit down and rethink what you do. If you really want to delve deeply into your business and get very good insight, I'll recommend you get the workbook and exercises by clicking on the link below. In this exercise and workbook, we delve very deep into your business to see what the numbers in your business really mean. Because sometimes, as business owners, we run our business and we don't really understand what our financial lecture is telling us or what changes we need to make. With the workbook and exercises, you'll be able to really delving into what is making you profitable, why, what do I need to change, how my policies make sense, they make sense for my specific business. And not only that, you get internal process analysis, like what areas in your business are you spending too much, or where can costs be delivered at less cost, where can processes be delivered at less cost. Using the information from 1 and 2, you can use that and create a 5-year budget so you can actually start being on track to direct your business rather than letting the wind blow you wherever the business takes you. So you're being proactive rather than being reactive.